In 2025, the global insurance industry collected 6.9 trillion euros, about 7.5 trillion US dollars, in premium revenue. Overlaying that volume is a jagged line. For 6 consecutive years, global catastrophic climate losses surged past $100 billion. Yet, the data reveals a paradox. In 2024, underwriting profitability improved because premium growth structurally outpaced incoming claims. Insurance functions as the primary mechanism for transferring potential loss, effectively establishing the baseline for global economic stability. Decoding exactly how this industry absorbs trillion-dollar shocks provides the most accurate indicator we have for predicting the future resilience of the entire global financial system. To understand how it survives these impacts, we need to reverse engineer the modern insurance market from its absolute first principles. The core axiom of the industry is simple math. Policyholders transfer the probability of a massive, ruinous loss to an insurer in exchange for a known, fixed payment of capital. Today, this mechanism faces a dual-front stress test, squeezed by escalating climate threats on one side and sophisticated digital vulnerabilities on the other. Despite these pressures, macroeconomic forecasts indicate this market is actively on track to exceed $17 trillion by 2035. Reaching that staggering valuation, however, is impossible without radically restructuring how the industry uses technology to process risk. We can map the operational architecture of the global insurance machine as a continuous 5-node value chain. Node 1 is risk assessment. Here, actuaries process historical data to evaluate the exact probability and severity of potential hazards. That data feeds directly into Node 2, underwriting. This is the mechanism that determines specific policy terms and locks in the price of the premium. Node 3 covers distribution, mapping the vast network of sales channels, from traditional human brokers to automated digital platforms. Node 4 is claims management. When a risk becomes a reality, this node handles the verification and the eventual financial settlement of those losses. Looking at these 4 steps, you see a continuous dual flow. Premium capital moves forward through the system, while the liability risk flows backward onto the insurer's balance sheet. To keep that balance sheet from breaking under extreme weight, the chain relies on a critical 5th node, reinsurance. This acts as the systemic shock absorber. Primary insurers use this final layer to offload highly concentrated catastrophic risk, preventing their own insolvency during major disasters. This global backstop is executed by massive, specialized entities like Swiss Re and Munich Re. Without this ultimate buffer absorbing the heaviest blows, a single severe global catastrophe would collapse the entire operational chain. That operational chain is governed entirely by a strict mathematical dashboard, tracking 4 main KPIs: solvency ratio, return on equity, investment yield, and the combined ratio. For evaluating an insurer's operational health, we isolate the combined ratio. The equation is specific. You take incurred losses plus operational expenses and divide them by earned premiums. This establishes an absolute boundary. To generate an underwriting profit, an insurer's combined ratio must stay below 100%. With that core ratio secure, insurers then chase secondary targets to maintain corporate health, typically aiming for a 10 to 20% return on equity and a 3 to 8% investment yield. When the market posted broad profitability in 2024 and 2025, it was because companies successfully forced premium rates to rise faster than the massive volume of incoming claims. Every new corporate strategy, technology rollout, and policy adjustment exists for one reason: to force that combined ratio down. Bringing our 5-node value chain back into view, we can map exactly where modern external pressures threaten to push that ratio into the red, primarily straining underwriting and claims management. Climate change is a primary stress vector. The increasing frequency of natural disasters is overwhelming historical risk models, severely testing the capital limits of reinsurers. Simultaneously, rapid digitization has opened a second vulnerability, exposing legacy systems to severe cyber threats and a multi-billion-dollar wave of global fraud. Compounding these issues is a tighter global regulatory environment, forcing insurers to lock up higher amounts of stagnant capital in reserve. The industry is deploying AI, big data, and the Internet of Things as structural solutions to these specific nodes in the value chain. By integrating IoT and telematics, insurers receive continuous, real-time data streams. This replaces historical guesswork with hyper-accurate, individualized underwriting. In claims management, deploying AI and automation algorithms allows companies to instantly flag fraudulent patterns and drastically lower the operational expense ratio. Embedded insurance integrates coverage seamlessly into digital point-of-sale platforms, entirely bypassing traditional distribution costs. To address the climate vector, vast datasets covering environmental, social, and governance factors are fed into predictive models to accurately price long-term physical risks. With underwriting profitability tied strictly to expense suppression, integrating these technologies becomes a primary strategy for defending the combined ratio against escalating external claims. Zooming out, this geographic heat map shows where that 6.9 trillion euros is concentrated. North America commands the mature market, accounting for over half of global property and casualty premiums. Contrast that with Asia, where India recorded a 15.7% surge in new life insurance premiums. Controlling these regional markets are legacy corporations, with total assets rivaling the GDPs of small nations. Germany's Allianz stands as the largest player globally, wielding over $1 trillion in total assets. Meanwhile, giants like Ping An command China, leveraging their scale to dominate the fastest-growing domestic market on Earth. These staggering balance sheets give legacy insurers a massive capital advantage. When digital startups attempt to disrupt the market, the legacy giants possess the financial weight to simply imply them. Looking toward the next decade, analysts identify 3 specific product sectors driving expansion. First, cyber insurance. Second, data center coverage. And finally, climate risk adaptation products. These are amplified by powerful demographic tailwinds. Rising global wealth and aging populations ensure continuous demand across the life and health segments. Driven by these factors, industry forecasts project the total global market valuation will aggressively expand past $17 trillion by 2035. However, this trajectory remains highly sensitive. The forecast depends on navigating severe catastrophic loss events, abrupt regulatory shifts, and interest rate fluctuations. The insurers most likely to reach this $17 trillion valuation are those using AI to model physical risks with extreme mathematical precision.